Welcome to Real Estate and Taxes with Lakshay. I will be helping you minimize your taxes. Good afternoon, everyone. Thank you for joining in on my Tuesday session on real estate and taxes. Today, we're going to be talking about 5 strategies Canadians can use to reduce their taxes amid the trade tensions. So the very first suggestion I have is shift your investments to tax advantage accounts. What do I mean by this? In Canada, there's 2 types of tax advantage accounts, RRSP and TFSA. TFSA is usually used for tax-free savings and growth. So most of the time people buy stocks in a tax-free savings account, and as they grow their investment portfolio, they don't have to pay taxes when it grows. But RRSP, on the other hand, is actually taxed. RRSP is Registered Retirement Savings Plan, where you basically save money for your retirement. At the time when you retire and you withdraw the money, this money gets taxed. But Canada and US has a tax treaty that in an RRSP, withholding tax will not be deducted. So if you have investments in a TFSA, you might be at a loss of 15% withholding tax if you hold any dividend paying foreign stocks in the US. But if you move that to an RRSP, this will not be the case. So my first suggestion is move your investments to RRSP if it is a dividend paying stock in the US. So the second strategy we have for today is income splitting and family trust. So because of the market volatility right now, it is a good idea to move your investment income to a trust. And how is that going to help in reducing taxes? Well, here's how. If you have a family trust, you can basically pick and choose who you want to pay the income of the trust to. If you keep it in the trust, it's going to be taxed very heavily, but you might have lower income family members that you can split this income to. As for example, for $25,000. If you paid for $25,000, we already know in Canada on the first $25,000, there's not much taxes. So splitting income through a family trust is a great idea during this time to reduce your overall tax burden. So the third strategy we have is use a holding company to defer taxes. Because of the global disruptions right now with the trade war, a lot of the time income predictability becomes hazy, right? You don't know if you're going to be collecting all of the income that you have made in the foreign country and it's going to come back to you in time. So right now it's difficult to understand, is it going to be high or is it going to be low? So what I suggest is incorporating your business as well as using a holding company to park your profits rather than paying taxes personally at 53%. So how can we avoid paying 53% tax? Well, incorporating yourself. Once you incorporate yourself and any money that you have in the operating company, you can move it towards the holding company and park your profits and not have to pay a dime. Why? It's because taxes are only paid when you withdraw money from the holding company. Within the holding company, you're going to basically move the money from the operating company to holding through an intercorporate tax-free dividend, which basically means that you have already paid your taxes within the operating company. For first 500,000 is 12.2%, and once it moves through the holding company basically doesn't have to pay taxes unless you withdraw money from it. So my suggestion is invest in commodities through the holding company to fight against the currency devaluation that is happening because of the trade war. The 4 important strategy to reduce your taxes is writing off interest and writing off investment loans. A lot of the time people forget to write off, interest that is paid on, investment loans or anything that you basically have carrying charges on, you can write off. Even if you have paid foreign taxes, you should be filling out a foreign tax credit form, which will help you basically reduce your overall tax liability. The foreign tax credit form will allow you to basically not have to pay double taxes. And the form to basically keep in mind while reporting your overall worldwide income is T1135. Make sure to, check this form diligently because it has 2 options. One is a detailed method and one is a simplified method of reporting your foreign income. So make sure to work with a qualified accountant. Otherwise, it can cost you thousands of dollars in taxes and penalties. So number 5, last but not the least, is my favorite one, which is offsetting capital losses with capital gains. Let's assume you had a property that you sold for a capital gain in a previous year. Right now, if you look at your stock portfolio, it is at negative. If you make a capital loss today, you can technically offset that capital gain that was reported previously and basically write it off. capital losses can reduce your capital gains and basically your overall tax liability. So even if it was 3 years ago, you can actually look at revising your previous year tax return to basically incorporate this. And if you don't have a capital gain yet, you can even use it in future years. The good part is you don't have to revise the entire tax return. You can file a form called T1A adjustment, which will only report your capital loss carry forward in the previous year and basically reduce your overall taxes. So what is in conclusion? My conclusion is another takeaway, maybe invest in physical assets like gold and silver and keep it in the locker. This way, gold is actually a global currency and hopefully it doesn't drop as much as your stocks have. So also, don't forget to reclassify your TFSA investments which hold US stocks and are paying dividends to an RRSP. RRSP is governed by 15% exemption on withholding taxes because of the treaty. So holding it on an RRSP is a much better option. And if you're still confused and you want to future-proof your wealth against big tax liabilities, make sure to book a call with us and we'll be more than happy to plan it out for you. Thank you and have a good day.